I think just being prepared, being open, and I think, stay curious. What made the great economists great is that they were always engaged with the big issues of the day, even if it wasn't easy, even if it was messy, even if it wasn't quantitatively as, neat as their models. But I think it's that degree of engagement. That's what I mean by be curious, be open.
Hello, and welcome to Season 2 of Conversations on Climate, the podcast series which has been developed in partnership with the London Business School's Alumni Energy Club, in which I've been leading a series of conversations with experts from around the world exploring the biggest challenge of our time, climate change. Today we're at London Business School speaking to one of the world's leading economic voices. London Business School's Professor Dr Yueh has packed an almost unbelievable amount into her career across multiple fields. Starting as a lawyer, switching to economics, becoming a journalist and presenter alongside academia, and amassing a deeply impressive group of advisory chair and directorship roles. Linda's published nearly a dozen books, has been awarded a CBE for services to economics, and has acted as both chief business correspondent for the BBC and as economics editor for Bloomberg. We had a great conversation covering why the climate emergency will bring about another financial crisis, and what the great economists of the past can teach us about the energy transition. One that you won't want to miss.
Around 80% of people who listen to this podcast haven't hit the follow button. If I could ask you for a small favor, if you do enjoy our conversations, please do hit that follow button on your app. It would help us in the show more than I could possibly say. Thank you, and enjoy the conversation.
Linda, thank you so much for spending the time here to speak to us. It's much appreciated.
Thank you for having me.
So when we look at your body of work, one of the two great themes that come out are, one is you're an unbelievable communicator of economic ideas, and two is you've got a great feel for the history and what lessons we can learn from history. Which leads us to your book, your latest book, which is on economic crashes. Can you tell us a little bit about the premise of the book, why you decided to write it now?
That's very kind. I always think it's one of the things being here at London Business School, you have to be able to communicate your ideas. And so this book, The Great Crashes, follows on my previous book, The Great Economists. And they're both accessible. They're meant to introduce the big ideas from history so that we can learn lessons from them. So actually, funnily enough, both of the subtitles of the book refers to lessons. So The Great Economists is The Great Economists, how their ideas can help us today. And my current book, The Great Crashes, Lessons from Global Meltdowns, and how to prevent them. And so, so one of the things that which I find fascinating, look over the course of economic history, is it's just, Mark Twain is right. History doesn't repeat itself, but it does rhyme. And so, unfortunately, as we're sitting here today, we just had, it's actually, if not the largest, certainly the second biggest bank run in history, with Silicon Valley Bank. So the Great Crashes takes us through all of the major financial crises since the Great Crash of 1929 that led to the Great Depression of the 1930s. And then it draws out lessons for how we can try and, as the subtitle says, prevent the inevitable crisis from becoming a global meltdown. So in other words, not every crash leads to a systemic banking crisis like you saw in the 1930s or 10 years ago with the global financial crisis. So this book draws out those lessons and, and hopes that there will always be a crisis, but we don't have to suffer a decade of recession on the back of it.
Yeah, fantastic. And this is unfortunately a subject that people have come back to a few times more than once, which kind of implies that there's the lessons aren't being learned and that we're repeating mistakes of the history. Is there something that is kind of structurally an issue within the economy that causes of these crashes to repeat?
Yeah, no, great point. I think so. Every crisis, essentially, it's like Mark Twain said, it is somewhat different, but they share common traits, and that's the theme I bring out through the book. So the common trait is euphoria. So there's always this belief that the market will just continue to go up, whether that's stocks or housing. And if that euphoria is fueled by debt, that is when the inevitable bust could turn into a crisis. So in other words, not every stock market crash ends up leading to a recession. Not every housing crash leads to a global meltdown. But the ones that are filled with debt have, unfortunately, the propensity to bring down the banking system, and that's what leads to very prolonged crises. And the second shared common characteristic across history is credibility. Crises are only resolved when they're credible policy. So one of the chapters in the book is on Japan. So the IMF, the International Monetary Fund, whose remit it is to look after global financial stability, they would normally say in the first 10 months of how you deal with a crisis plays a big role in the aftermath, which of course is something all crises share. Japan took at least 4 years before they did something about the early 1990s real estate crash, and therefore they ended up with lost decades of economic growth. So euphoria, the amount of debt, and then the credibility of policy is what all crises share in common, and those together lead to the aftermath. So as I say, the worst one-day crash in US stock market history was the 1987 crash of the stock market. Hardly a blip on the real economy. However, if you think about the numerous dot-com bubble, just as one recent example of the early 2000s that burst, that led to a recession in the U.S., albeit a shallow one, and then that had global. There was an early 90s recession. There's an early 2000s slowdown. So you can begin to get a sense that crises are pretty regular. And they do tend to, lead to, depending on these factors, an aftermath, which is quite could be quite, troubling for people as they look at unemployment and they face, economic stagnation, and then other times, people. Some traders lose money and nothing happens.
So some of the signals there would be debts, euphoria, sense this time is different. What can we do to mitigate it?
Yeah, so another great question. So I think the other term that I use in the book is exuberance. So euphoria and exuberance tend to be used together. So again, going back to the dot-com bubble, irrational exuberance was coined by Bob Shiller, the Nobel laureate from Yale University. So how can you mitigate against exuberance? And the whole point of irrational exuberance is that you can't. It's human nature to just believe that asset prices can only go up. So the key factor there is debt. Can you, as a regulator, try and mitigate the amount of debt that's offered by the banking system in particular, to try and not fuel that exuberance or that euphoria. So that's one of the differences between a stock market, crash that doesn't lead to a massive economic, decline. It's because it's not a huge amount of debt on the back of it. So some traders might trade on margin, so there's some leverage, but it's the extensiveness of debt from the banking system, which leads to the worst recession. So that's where regulators can play a role. They can't do much about human behavior, but they could, try to regulate the amount of debt. And of course, the most important thing is they can be credible in terms of their policies. So, for instance, one of the big changes over the past decade since the global financial crisis is that banks now actively use macroprudential policies. So they use policies like leaning against the wind. So in other words, what happens is when the value of an asset, which is the collateral on a loan, goes up, it actually makes it look like the collateral is more valuable on a bank's balance sheet. So the natural tendency is therefore to say, actually, we could lend more. So leaning against the wind essentially says, actually, when you have a certain amount of leverage in the system, in a macro sense, banks could face regulators saying that we're going to limit your loan-to-value ratio, or some way of pushing against this natural tendency for more credit to be available when asset prices are rising. So that's one example. And that, by the way, I write in the book, is actually a change from the Fed policy. Alan Greenspan, obviously, famously during the dot-com bubble, tried, but found it very hard to take away the punch bowl. And in the book I write about, that actually dates to 1955, when the then Fed chairman said, for the central bank to, essentially to lean against or even, try and deflate a bubble, it's like taking away the punch bowl when the party is getting started. So now central banks are they are deflating. But it is, as I say, it's inevitable we'll have a crisis. The only question is, how much regulators can try and mitigate the impact. And one of the other things that policymakers, what we saw in the COVID crash did, is that they extended extensive income support to people, because obviously people are, the pandemic was just an incredible hit to so many people. But supporting their incomes, because remember, recessions are just when incomes fall, and then extending, loans to viable businesses so that, they can withstand a liquidity squeeze. So those are the kinds of measures which can also help cushion the impact on the real economy. So there's a number of things that, policymakers have the tools to do. But the other thing you mentioned, this time is different, is every crisis is different. Most of the tools are designed for the last crisis. So if you look at, for instance, Silicon Valley Bank that I mentioned at the start, it's a mid-tier US bank. It's not subject to the same degree of regulation as the systematically important financial institutions. So that's a great example of, maybe mid-sized banks are not, don't need to be subject to this regime. And then it turns out, actually, they are systemic according to the US regulators. So therefore, so that to me is why no set of tools will ever be perfect.
Yeah. Well, that's a very good example of the power of lobbying. Okay, well, thank you very much for that. So it seems to me that the current tools that you're talking about, that regulators have been brought in, they've only been exercising them because they've really been forced to, because inflation has gone up, out of control, and therefore they're trying to wrestle that punch bowl away. But after having people stumbling around in oblivion for an awful long time, loading an awful lot of debt up onto their balance sheets. So going back to the core of the reaction that regulators have to financial crises, to slightly misquote Churchill, never waste a good crisis. And the way that we react to crises can tell us quite a lot about the priorities of a society. How would you see, but this is obviously a conversation on climate, how would you see our reactions to financial crises, the kind of more recent financial crisis from the Great Financial Crisis up until to COVID, and what has that shown us on our general reaction towards climate and climate change?
Yeah, absolutely. I mean, firstly, I should say, I have a chapter in the book which is dedicated to what's being called the Great Reset. So this is indeed, I think especially the COVID-19 crash just made people sit back and think about the quality of life they want, the kind of society in which they want to live. And so one of the concerns during the pandemic was, with all the focus on public health, would it actually take attention away from the urgency of climate change? And actually, it turns out that it's such an urgent issue that global public goods encompassing both health and climate were very high on the agendas of not just policymakers, but importantly, and this is a lesson from history, stakeholders. So the Great Reset essentially is when I try and draw out things like, in the pandemic, obviously for a time, pollution fell because people just weren't traveling, they weren't flying. But as economic activity resumed, people have begun to think again about whether or not they need, to jump on that plane, or whether or not, where their food is sourced from, the carbon footprint of their activities. And I think that kind of Great Reset, where it's pervasive across society, that's actually how a paradigm shift happens. So I think about my previous book, The Great Economists. I write about the welfare state, which didn't come into being until the early 20th century. It was triggered by the Great Depression of the 19th century, known as the Long Depression. And at that point, unemployment entered the dictionary for the first time. And so the capitalist society, the Industrial Revolution, didn't have a social safety net. And when people became unemployed, when there was a financial crisis, when there was a depression, people thought again and said, actually, this is not the kind of society that we want to live in. And there was a big alternative, which is the rise of communism and socialism at that time, as a battle of ideas to say, actually, we want to live in a more egalitarian society. And fast forward to today, it's the destruction of our planet that I write about, which is also essentially a pause and a reset. And people will say, I want to live in a greener, fairer society with a better quality of life. And this paradigm shift can only happen if you have, what I described in my previous book. This battle of ideas wasn't just among politicians. It was all of us. That's how the stakeholders of society play a role. So on climate, we as individuals, we can vote for politicians who support our values. We can buy from companies that abide by ESG, environmental social governance concerns. We ourselves can take action. We can limit our carbon footprint. We can recycle. We can promote net zero. So all of that is essentially how de jure laws and regulations can be effective by de facto buy-in and the consensus shifting. So I think the great crash that we've just had of COVID, which was absolutely horrific in the years that people suffer through it. If the lesson we can draw from that is that more people now can work from home, so you can see a behavioral change, extending it to greening the economy and a fair society on the back of it. To me, those would be the lessons that we should be drawing, from recognizing actually we can, as a society, stop and just change the way in which we work and live. We should extend that and make it a paradigm shift so that we can protect the environment.
Yeah. What do you think the role of the regulator and the state is in all this? Like, for example, do you see a role for central banks to have carbon as part of their mandates? We're pretty narrowly focused in on inflation rates. But let's say kind of Europe has also committed to net zero by 2050, with other target 2045. Is there a space for example, the central banks to be told, well, that is also part of your mandate?
Yeah, so I think there's a huge role for policymakers to play. I think it's both, on the fiscal side, and you mentioned Europe there. The European Central Bank has included sustainability as one of its objectives that it's looking at, because central banks buy assets, and the introduction of green bonds is another way where, projects which are environmentally friendly should be priced differently than bonds which are financing, brown assets. So I think all of those things are part of the change that has to happen if we want a paradigm shift. So in fiscal policy, I think it's very clear that the pandemic support programs done by, say, Germany and France were very geared at the transition to net zero. So for instance, Germany was mandating having charging points, in its, probably soon to be no longer called petrol stations. France was keen on, on financing green industry. So I think that, governments are all faced with a growth challenge, which is the other longer term structural challenge for lots of advanced economies. So the green transition offers the possibility of investing in new innovative industries where the current stock of capital is lower than it is for, say, traditional industries. The IMF makes this point when they were arguing that you would get a higher return from investing in green assets, putting government money that can bring in private money into areas which if we think about the possibilities, are just immense. Everything from hydrogen to, to solar. I mean, there's so much investment that could be had, and they estimate that investing during times of uncertainty actually gives you a greater bang in terms of, the pound, the euro, the buck invested, in terms of not just output, but in terms of jobs, green jobs. So to me, that's the paradigm shift that's required. You need to have the legislative, the regulatory changes that go alongside that. And then companies increasingly are facing regulators who are saying you need to set out your net zero plan, your transition plan. You need to look at climate as a risk. Is climate change going to be a risk to your business? And if so, how do you mitigate against that? You need to make sure that your plans for the future, because these are, these can be, businesses, we tend to think of them as reporting every quarter, but they all have strategic plans. Some of this transition will take time. If you think about, for instance, warehouses that need upgrading, all of that, they need to consider that and finance it and help with the transition. And the regulators asking for reporting on it, and then shareholders can hold them accountable. So to me, that's the change, that thankfully hasn't been stymied by the pandemic. I would say in the last few years, there's been a lot of focus on ESG and bringing all the parts of society together in order to make concrete steps, towards climate change.
Great. That's a very optimistic point. It may drag us back to pessimism and the idea of crises again. So Mark Carney, amongst others, have been banging the drum about potential need to dramatically reprice a lot of financial assets purely because of climate. And this is, that sounds to me like a pretty classic cause of a financial crisis, like dramatic repricing of assets. Do you agree with him? Do you think that this is something that we need to be worrying about? Like, examples might be large amounts of property built within flood areas because insurance companies are insuring them now. Well, they really shouldn't be. If they made a kind of rational calculation, they shouldn't be. But they realise they can not redo the policy next year. Then it becomes the government's problem. It becomes the state's problem. To be, what do you do with all these people? And the impacts of climate upon everybody's daily life and business is going to cause, to some degree or other, a financial shock to all of us. Do you think that could be like a cause of the next, or maybe not the next, but a future financial crisis?
Well, I certainly think if the risk is large enough, and certainly the point about insurance companies and areas which are prone to flooding, some insurance companies step away from that and won't insure that. But you're absolutely right, and there's been quite a lot of focus on areas, for instance, in the US, where insurance companies continue to have a balance sheet, which is at risk from dramatic changes in valuation because of climate change. So one of the things about having written a book about the great crashes is, I think that climate, this area, which generally speaking regulators will call shadow banking, because clearly there are lots of different components of non-bank finance. I think there are all possibilities for the next crash. In my book, I write about China because it's just overdue for one, because 40 years of nearly uninterrupted growth is it defies economic logic, and so it'd be weird if China didn't have one. But I make the point of saying it may not be the next one. It's just that when it has one, it will be a great crash. In my previous book, again, I write about J.K. Galbraith, the great economist, who said economic forecasting exists to make astrology look respectable. So, but the point about climate risk on, balance sheets, that's, I think, why regulators are very keen that businesses, take a look at their assets and price in the risk of climate, which is why I think the reporting requirements have changed. So it's not just looking at how do you transition and what are your milestones. It's actually the valuation of what sits on your balance sheet, have you, properly priced in risk, for climate change? And the various companies that, so it's not just insurance, it's also companies that operate warehouses. Are they in potentially flooded areas? It's companies that have, goods in warehouses that, could potentially, flood, or companies that are house builders, and they're building in areas which, again, may actually, be at risk of eroding one of their, major projects. All of those things, I think, could potentially trigger tensions, we certainly saw insurers coming into focus with AIG in the 2008 crisis. They were essentially rescued because they owned a lot of, essentially insurance on default. For Lehman Brothers. And so absolutely, that is an area, but we also saw recently liability-driven, investment strategies or pension funds were caught out by the changes in interest rates. So again, all of that, not traditional banking, but what I think, increasingly is called shadow banking, because there is a lot of potential risk around that sector. It may well be that is, that could be, if not the next, then, a future crisis, as you put it.
And so as part of the subtitle of the book, and how we prevent them.
Yeah.
Are you suggesting that we are doing some of the right things to be trying to prevent them by forcing companies to be looking at these and to be repricing? No, obviously, if we took a big red pen and we tried to reprice everything in the morning, then there would have to be a financial crash. Like if, for example, you took Shell or BP and said, all of your reserves, you can't do them anymore. Well, the economy just collapses around us. That's life. But are you suggesting that the regulators are taking some of the right steps to say you need to be looking at these and repricing them slowly over time, so that as it becomes more apparent that these issues are occurring, you're more accurately priced? Is that, or am I misreading that?
Yeah. So the subtitle is that to hope that a crash doesn't become a global meltdown. Mm-hmm. So subtitle is lessons from global meltdowns and how to prevent them. Yeah. But we will not prevent the next crisis. We will have another crash. We will have another crisis. The question is, can we prevent the extensiveness of it so it doesn't affect people's livelihoods for years and years? So one of the ways in which regulators are focused, an area we haven't discussed yet, is around fund management, asset allocation, so investment companies. So what they are pushing investment companies, who obviously are the shareholders in lots of companies, so this is another part of the jigsaw, the financing community. The reporting is on what are your principal risks and then what are your emerging risks. And it is an ESG framework that's put around it. So in this country, it is, it's different for different countries. But for this country, it is trying to say what are the principal risks that your investments face, and then what are the emerging risks. So one of the challenges for lots of companies, because remember, they know their business best. However, they also need, I think, to especially if you're looking at, I would say, companies who've either been around for a long time or startups, both of whom probably think they're, one of them thinks the operating model is pretty good. The other one thinks, we don't have people to look at this. So I think that's where the financing community plays a role, which is to look at their own portfolio, engage with the companies and say, actually, I think for your industry, climate is more than an emerging risk, it's a principal risk. But there may be other industries where, the impact is over, say, a longer period of time. It may be more of an emerging risk, because as you know, different challenges. So we've talked about flooding, could be biodiversity. The environmental challenges come themselves in different ways. And I think having companies look hard at how they operate, at their assets, and at their balance sheets, the financing community can engage with them because they also can see, for instance, lots of companies in the same sector, or they can see lessons from different, sectors that can be brought to bear in a company to say, actually, how have you valued this? Have you properly looked at the risk around this? Is there any way you could change the way you operate to mitigate against it? So, and I would say that a number of the startups, they may not have fully fledged ESG departments because they're startups, but a lot of the startups are very focused on being sustainable, both in the environmental and the social sense. A lot of them are disruptive because they're sustainable, because they are looking at how their impact on society, so, even, I can think of companies who produce, say footwear, but the way they produce it is environmentally sustainable. That's their USP, that's their selling point. So to me, those companies also have the potential to disrupt traditional companies who may get a little complacent. And that's the other lesson from history, right, that I write about in my previous book, which is, Kodak was offered, a camera which didn't use film, which to us today would be, yeah, okay, but they didn't want to disrupt their existing market. So to me, this is all part of the paradigm change, which, I'm glad to see, has come out over the past few years strongly.
Right. So your previous book, The Great Economists, was a fantastic, one fantastically successful, which shows there's very good, a lot of appetite and a lot of interest in the area. And it was a great pulling together of like 12 of the greatest economic thinkers. So which economists from the 12 would you think is most influential on the way we deal with climate as an economic incident today?
I would say Robert Solow's work on growth models, his work in the 1950s still formed the basis of what we call neoclassical growth models. It's on the basis of thinking about the economy being comprised of capital, labor, and then technology, which can boost productivity. So that way of thinking about valuable assets, so for instance, capital could be green capital. I think that stream of work, and that's how I treat the book, which is I start with the seminal models and then I take you through how it actually changes. And then if you fast forward to William Nordhaus, also at Yale, who won the Nobel Prize for incorporating environmental climate considerations into macro growth models. That's the basis of how you can think about calculations of, say, green GDP. What would growth be once you consider the impact on the environment? And I think it's that way of, and all growth models have a degree of, intertemporal quality. So consumption tomorrow versus consumption today. And those have generated quite a lot of debate about what is a proper discount rate to use, to have a sustainable planet in the future. How much do you really discount that towards, today? And these are the kinds of models that I think make for, for those who are not convinced, especially the quantitative evidence that this is something that needs to change the way in which society grows in a qualitatively, improved way, and not just, quantitatively, which is how, traditionally growth has been thought about. And that's where the idea of green GDP is interesting, because that is a qualitative as well as just a quantitative. If you grow strongly, but you're destroying the planet, how can you not consider that, given that natural capital is, non-replaceable, which means you would place a huge value on it, and you wouldn't discount that very much in thinking about your actions today. So I think that whole stream has generated, models, evidence, quantification, and has helped, we've been talking about stakeholders pushing the issue along. That's another set of stakeholders, I would think, pushing, the issue along.
Great. So in the environmental space, there's an awful lot of conversation going on about green growth and versus degrowth. What do you think he would have thought about that debate and the obvious tension between the two ideals?
I think when you grow in a qualitatively different way, economists have actually long discussed the idea of utility. So, we think about firms as profit maximizing, but people are always thought about as utility maximizing. So what actually feeds into your utility function? This is actually an idea that goes to philosophers, like Mills. This is not all the early economists from that book are actually philosophers. Economics as a subject didn't actually really exist until the turn of the 20th century, when the neoclassical economist Alfred Marshall created the term economics. It used to always be called political economy, it was always very philosophy. So the basis of welfare economics, thinking about utility, is that people maximize their utility, which is based on consumption of not just work but also leisure and their quality of life, really. So it's the qualitativeness of the growth that I think has shifted on the way that we think about it. There are lots of challenges around the slowing growth rate. So for instance, some economists would say, as our growth rate slows, we really couldn't afford to finance, say, the NHS, or public services. And that's a big debate in aging societies like in Europe. And I think there is a whole set of issues to debate there. But I would step back and say, if you want to grow in a qualitatively different way that maximizes your utility, enjoying the planet and enjoying the environment, then utility has a long-standing tradition in economics. And I think people make choices all the time based not just on money. They base it on lots of considerations. So, and society ultimately is made up of people making these decisions. So to me, that's the change that we've also increasingly see. We see it in the environmental space where people make choices. We also see it, we talked briefly about working from home. There's a survey recently of US workers that essentially found if your boss told you to come back to the office 5 days a week, about 2/3 would come back. About a third would come back and then secretly look for another job. And then the rest would just quit. And so I just think, again, in the Great Crashes, I write about how people's behavior have changed over the past few years. And I think that would only strengthen their conviction in acting in ways, that is environmentally sustainable as they go about, their work. And, companies are ultimately run by people.
Mm-hmm. Okay. And one of the other big kind of themes in kind of the environmental world now, which you kind of touch on in your book through looking at Marshall, is inequality, which we have touched on, and the whole idea of environmental justice and how do we reshape the economy in a way that doesn't increase injustice.
Yeah, absolutely. I mean, so Alfred Marshall was the Cambridge economist who essentially created the term economics. So the change in thinking in the late Victorian period, seeing the deprivation caused by the crises of the late 19th century, is laid the foundation for the welfare state. They realized by creating a social safety net, it didn't disincentivize work. It just gave people security and helped people who have fallen on hard times. So that parallel in the Great Crash is when I write about the Great Reset. And one of the Great Resets is around a fairer society, because inequality today, in the United States, for instance, it's being called the Gilded Age, the second Gilded Age. The late Victorian period was in the UK. The same period in the US was called the Gilded Age, famously captured by Scott Fitzgerald and other writers of the time. So the pandemic has actually showed that government can support incomes and support viable businesses in ways that support output and income in the economy, which is ultimately what GDP is. And so I write about the fact that inequality has been so severe, and yet we see that in a time of crisis, by lifting especially the poorest in society, we as society are better off. I think it changes the perception, just in the same way that happened a century ago. You see, it didn't disincentivize work. In fact, it saved viable businesses, and it helped people who were in very challenging straits. So if you look now to the cost of living crisis, which I also write about, the book is pretty up to date, offering, income support to help people with their energy bills. I see that as a product of the success of income support from the previous, couple of years during the pandemic. So to me, that changes the way we think about how support in an economy can help those who are least well off, and how it benefits, us all as a society. So, there's also debates about universal basic income that I touch on in the book, and ultimately we will settle on, I'm sure, something in the same way they did a century ago. But I think people are now more open to the idea that, having a focus on those who are least well off, is beneficial for everyone, and I think that could make for a fairer and a greener, society going forward.
Yeah, what a fantastically optimistic way to finish this. If I may, I've just got one last question. I always ask for a little bit of advice from our guests. In your case, I think what really struck me was quite how accomplished you are in so many things. So could you give some advice to people who might be feeling overwhelmed, or people who might think that they would like to be doing more with their life? What's the secret of doing so much so well?
Oh gosh, I think I've always thought that whose quote is this? Chance favors the prepared mind. So I've always thought that the more you enrich yourself, the more that you're open to opportunities, the more that you're engaged with the world. There's a lot of things that happen in life, which I wrote a book on the great crashes. Sometimes things happen, but I think just being prepared, being open, and I think, stay curious, always wanting to learn. But also, what made the great economists great is that they were always engaged with the big issues of the day, even if it wasn't easy, even if it was messy, even if it wasn't quantitatively as neat as their models. But I think it's that degree of engagement. That's what I mean by be curious, be open, which is to try and contribute in various ways. And then also, as we've discussed, I think utility maximization means we've always said you should value leisure. I think people should value leisure. I think you should think about the qualitative ways in which you can grow as a person, not just quantitatively. And that's a word for a person, but I think you know what I mean. But I think despite having written a book on the great crashes and on the great economists, which actually went back to the 18th century, the amount of progress with setbacks that we have seen, always makes me optimistic. That we've seen challenges before, some of which have been horrific challenges, and we have come through it. And I think it's just keeping that long-term perspective, which might also help. So maybe know some history.
Brilliant. Okay. Thank you so much, Linda. That was wonderful.
Thank you so much. Thank you.
Well, thank you very much for joining us on that conversation. We hope that you enjoyed it. We hope that you learned something. If you did enjoy it, please feel free to leave a 5-star review and to subscribe to any of our channels, and we'll be sure to keep you updated on future productions. This series is produced by United Renewables in collaboration with the London Business School Alumni Energy Club.